The Great Depression was the most severe economic collapse of the modern era. In just a short time, people went from wealth to losing everything and lining up for bread. What began in the United States quickly spread across the globe and helped push the world toward another major war. After World War I ended in 1918, America experienced a strong economic rebound. Soldiers returned home, women had joined the workforce, and businesses expanded rapidly. This period of growth, combined with new technology and cultural change, created what we now call the Roaring Twenties. Mass production reshaped daily life. Henry Ford's assembly line made cars affordable to ordinary families, and soon other industries followed. Radios, household appliances, and consumer goods were produced faster and cheaper than ever before. Advertising spread through radio, and consumer culture exploded. To keep up with demand, banks made borrowing easy. People bought products on credit, often spending money they didn't yet have. Confidence was everywhere. Parties were common, jazz filled the streets, and Wall Street became the symbol of success. Between 1921 and 1929, the U.S. stock market rose dramatically. As people heard stories of fast profits, more money poured in. Ordinary citizens invested their savings, and many borrowed money to buy stocks. Prices kept climbing, driven less by real business growth and more by pure optimism. However, the economy underneath was weakening. Global trade slowed, production outpaced demand, and Europe was still struggling after the war. None of this seemed to matter. Investors believed stocks could only rise. With margin trading, people bought shares using mostly borrowed money. By 1929, a huge portion of consumer debt was tied directly to the stock market.
The collapse came suddenly. In October 1929, panic selling swept through Wall Street. Over the course of days, millions of shares were dumped, and stock prices crashed. Within weeks, the market lost a massive share of its value, wiping out investors who had borrowed heavily. But the stock market crash was only the trigger. The deeper cause of the Great Depression was the fragile banking system. Banks had issued risky loans and invested heavily in speculative markets. When stocks collapsed, thousands of banks failed. There was no deposit insurance, so people lost their savings overnight. Fear spread fast. Even stable banks faced runs as people rushed to withdraw cash. Lending dried up, businesses closed, and unemployment surged. As people hoarded money, the total money supply shrank, leading to deflation. Prices fell, wages dropped, and debts became harder to repay. The Federal Reserve largely failed to act, allowing the crisis to deepen. Government decisions also worsened the situation. High tariffs were introduced to protect American industries, but other countries responded with their own trade barriers. Global trade collapsed, further damaging economies worldwide. By the early 1930s, the damage was overwhelming. Stock values had fallen nearly 90%, thousands of banks had disappeared, and unemployment reached historic highs. Homelessness increased, bread lines became common, and farming regions were devastated by the Dust Bowl. In 1932, Franklin D. Roosevelt took office and launched the New Deal. His policies reformed banks, introduced deposit insurance, regulated markets, and created programs to support workers and the unemployed. These measures helped restore confidence, but recovery was slow. The Great Depression finally ended with the massive economic mobilization of World War II. The crisis left behind lasting lessons about unchecked speculation, excessive debt, weak financial systems. History shows that when greed inflates markets beyond reality, the result is always the same: a painful crash.